Our year one EBITDA at our place can be calculated by summing the operating profit for each of the 4 quarters. Earnings before interest, taxes, depreciation, and amortization. So what we're going to start with is the operating profit for each quarter to eventually get to EBITDA. So in reference to your quarterly financial statements, the operating profit for the first quarter was $25,615, $44,060 for the second quarter, $48,084 for the summer quarter, and the fourth quarter operating profit was $50,381. So the annual operating profit at our place was $168,140. Earnings before interest, income taxes, depreciation, and amortization. So if you look at the occupation cost section of any of the periods at our place, we want to determine which expenses in the occupation cost section of the statement of income are not included in EBITDA that must be deducted from the annual operating profit. A review of that account or area of the statement of income will demonstrate that property taxes must be paid. In order to get to EBITDA, we have to deduct the property taxes for the year from the operating profit. We must deduct the liquor license fees for the year from the operating profit to get to EBITDA. And lastly, at our place, we have to deduct the insurance from the remaining operating profit to get to the final EBITDA number. So from the $168,000, $140,000 operating profit, OP, we have to deduct $25,108, which represents 4 quarters of property tax payments in the amount of $6,277. If you can audit this value in the occupation cost section of any of the 4 quarters statement of incomes. That's the property tax. Next is the liquor license. From the operating profit, we have to deduct the annual cost of the liquor license, which is $6,000, which is 4 quarters of $1,500 worth of expense, and the insurance in the annual amount of $22,808, which represents 4 quarters of $5,702. Those 3 subtractions from the annual operating profit will give us the annual EBITDA, which is necessary for our remaining financial calculations. And the result is $114,224, which is equal to the first year's EBITDA, earnings before interest, taxes, depreciation, and amortization. Now that we have determined the annual EBITDA for our place, we are in a position to calculate the return on net assets. Now, the net assets are the total assets less the current assets. Net or long-term assets. Total assets less the current assets equals net, also called long-term assets. If you refer to the total property line on the balance sheet at our place for the opening day balance sheet and set that aside, we also want to see the total property balance on the fourth quarter balance sheet at our place. Because we need to calculate the average annual net assets to perform this calculation properly. Over time, what's happening to the assets? They are being depreciated. And the asset balance or value is declining over time as a consequence of their depreciation. This EBITDA has been generated over the course of the entire year. So for accuracy, we want to calculate the return on net assets on the basis of their annual average. And to do so, it's very simple. We're going to take the opening day balance for the total property. We're going to add it to the year-end balance for the total property. Opening day balance sheet, fourth quarter balance sheet, the end of the year, and we're going to divide it by 2. Just like we might calculate an average inventory value to calculate inventory turnover, cost of goods sold divided by inventory average over a period of time. Beginning inventory plus ending inventory divided by 2, we have 2 observation points, is the average inventory. The same concept applies to the total property. Opening plus ending divided by 2. So at our place, if we refer to the opening and closing balance sheets, opening day and period 4, the opening day total property, fixed assets, long-term assets, $552,200. At the end of the year, their book value was reduced to $518,200 due to depreciation. We divide the sum of that by 2, and we calculate the average long-term assets, or net assets at our place, to be $536,700. To calculate the percentage return, because return on net assets is a percentage value, we're going to take the EBITDA, the $114,224 annual return, and we're going to divide it by the average net assets of $536,700. That calculation produces a percentage of 21.3%. EBITDA divided by net assets equals 21.3%. Who gets the return on the assets? Well, we have to reflect on our balance sheet knowledge again. Promises were obligations that we made to the lenders. Prayers are what the owners have. And the return on the assets is distributed to these 2 groups of individuals, the lenders and the owners. The return on asset is shared between them. What's the return to the lender called? Interest. And we know by looking at the financial statements for each quarter that we have been paying the lenders for the use and enjoyment of their money over time. That's interest. We know that we've been fulfilling the principal reduction obligation by looking at the reduced value of the long-term debt and the capitalized lease on the balance sheet each quarter. Well, why is the return on net asset calculation important? Well, here's why. Hopefully the assets are earning more than the cost of financing them. So what we need to do is to compare the return on net asset percentage to the long-term interest rate. Because if the assets aren't earning more than the cost of financing them, what's the problem? We're not going to be able to generate sufficient cash to pay the interest for the use and enjoyment of the money, plus the debt reduction, the return of the principal that we borrowed from them, which is why this is such a critical measure. For an existing business that may be looking to expand their capacity, to increase their revenues, and hopefully their profitability, they'd have to be able to demonstrate to a lender that the additional funds that they're borrowing will be met with their ability to repay that. So they must demonstrate that the return on those additional assets is greater than the cost of financing those assets. We'll come back to this in a moment. So how does the RONA, return on net assets, compare to the long-term interest rate? Well, what is the long-term interest rate? We don't know, but we can calculate it. To do so, we have to refer to the formula for calculating the interest payment. And it's represented very simply as I, the interest payment, is equal to P, which is the principal, times R, which is the interest rate, which is what we're going to solve for mathematically, because nowhere in the documentation that we've reviewed so far today did we come across an interest percentage associated with the long-term debt. But we can calculate it. And the final component of the formula is T, which represents time. Since our financial statements are being constructed on a quarterly basis, the value for T, or time, is going to be 0.25, 1/4 of a year. Interest rates are always expressed on an annual basis, so we'll have to adjust for time.